Hello folks, this lesson is very important. We're gonna learn all essential parts of trading, of how to spot different signatures and price that will allow us to read the price better and eventually improve our trading. So here you can see all topics that we will cover today, and we will start with liquidity. So what is liquidity? Basically resting money that does nothing, what that information gives us. So we believe that market is moved by an algorithm, and there is an entity that we usually call smart money that are aware of this algorithm and take advantage of it. For smart money to execute their large orders, they need big influx of liquidity, either buy side or sell side. It depends if they're long or short. In simpler words, if smart money wants to enter in 10,000 mini position long, they need 10,000 mini people short. And how you can make people short? You can activate their stops. So that's basically what algorithm is doing. It seeks liquidity. So let's imagine that smart money is willing to go long. We need to make people sell. How can we do that? So we may induce people into entering long premature, and the people will put their sell stops. These sell stops will get activated once price reaches them. But where people will usually put their sell stops? Below the lows. So lows will get ran first before major move up. You might think, oh, this is just a fake out. But there are many lows. And you have to also include time to understand which ones are important. We will go over that in the next lesson, but for now, we need to know that below every low, there are sell stops, and above every high, there are buy stops. But you wanna primarily focus on old highs, equal highs, old lows, and equal lows. I didn't draw equal lows here, but let's do it that way. People treat these levels as support and resistance, or trend lines, so they also can be trend line liquidity. Because there are stops here, here, and here. So market always seeks liquidity for smart money to be able to execute their orders. So this is 1 minute chart, and we will go over some examples. Here you can clearly see that this is a trend line, so meaning that's a trend line liquidity. So every stop from here every stop from here got run. Because people put their sell stop here. This low didn't get run, but there are 3 lows, very obvious lows, and they got run. So smart money can enter long here. As you can see, this was very violent move to the downside to activate all stops, and then price kept moving higher. The same phenomenon happened over and over again across this price action. You can notice it yourself. For example, when we were moving down, when smart money runs out of liquidity, they run short-term high, lower, then they run a high. They move lower, they run a high. They move lower, they run a high. They move lower, they run equal highs. They're relatively equal, and you may think that there are many lows here, but that's why you need higher time frame context to understand where the price is heading to, where it wants to offset their position and reverse. As you can see, here also is very obvious example. Trendline liquidity, obvious low that people treat as support. So they entered long around here and put their stops at or a little bit below this level, and they treat it as support. Price violently moved, took out that low, people sell stops activated, so there was huge influx of selling, and so smart money or just aware traders of the algorithm were able to enter here. Now it's very important to understand concepts of internal and external liquidity. Obviously, it's all relative, but here we have this range. And in this range, I think it's obvious that external liquidity is here. BSL stands for buy side liquidity. And SSL stands for sell side liquidity. So I think it's obvious that these are external lows. Now this is buy side liquidity here, here, and here. I think it's obvious that this is all internal liquidity. Price always moves from internal to external liquidity. So here we took out internal liquidity and reached for external liquidity. From external liquidity, price will always reach for internal liquidity. With that said, let's check how it works on actual live examples. This is our range, and you have to spot internal and external liquidity. This is entire range, so external liquidity is here. And here. The bias was bullish, so we look for internal low to get taken. What's the most obvious low that is internal? You might think about that one, and that's okay, but this one is much more prominent. Once we take out internal sell side liquidity, we reached for external buy side. By the way, internal liquidity got taken here once again to take out even more sell stops, to buy even more and add into this position. Also, it tapped into the zone with a sweep, so this was very high probable setup. Here you can see equal highs, and as you've learned right now, all equal highs and equal lows get run after they do their function. As you can see, the function of these equal highs was taking this low and mitigating this zone. You got to understand that always smooth edges in the market get jagged. Whenever you see some smooth price action, you got to understand when it has done its function, and then it will always get run. Example, this very clean trend line. Yeah, it's a little bit overshot here, but overall, this looks like a very clean diagonal. After it manipulated lower, it got jagged. Let's check 15-minute time frame. I think it's gonna be much more clear. As you can see, here we were in kind of triangle pattern, and even here we induced people into thinking that support broke and turns resistance, and eventually we went higher. Also here was a trend line liquidity, and that, just by the way, this low alone, this high alone is very obvious and standing out so it got taken. So now let's explain fair value gaps. Fair value gaps are very important, and this is a bullish fair value gap or imbalance. Let's mark them all out. I just drew a few different variations how they can form. They all have the same function. So what is imbalance? When price is printing, we might create a candle that does not get overlapped by wicks from both sides. So for example, if this wick here would overlap it, it wouldn't have been fair value gap. And the same thing from the other side. If it gets overlapped, this is not fair value gap. If it's like that, now this is fair value gap. If it's even smaller, now this is fair value gap. Or imbalance, whatever you wanna call it. The midpoint inside the gap is a very important point. It's the most sensitive, but it might not get reached. Imbalance signifies displacement and price action and willingness to move from point A to point B. Whenever you're in a long trade, you wanna see imbalances to form in direction of your take profit. And the same thing for bears. Now I will show you how bearish fair value gap looks, and we will go on to live examples. So these are examples of bearish fair value gaps. By the way, on the right side I drew candles a little bit incorrectly, but never mind, the same thing is happening here. Also, you wanna pay attention. These are examples of bearish fair value gaps. Midpoint of any fair value gap, or just gap overall, is called consequent encroachment. Bearish fair value gap has everything the same as bullish fair value gap, but the direction is different. Also, I forgot if I mentioned, but when I was showing bullish examples, I drew the last example incorrectly. So now let's move on and see actual live examples. We are on 15-minute chart on Bitcoin, and as you can see, here 50% or consequent encroachment of that bullish fair value gap got respected. Now I'm not gonna get into details how to pick the right one. I'm just gonna show examples, because here you might see that they did not work. So how to understand which one will work and which one won't, you will learn in the next lessons, because obviously these gaps are everywhere and not all of them are getting respected. Here is an example of another fair value gap, and as you can see, we didn't reach midpoint. Here is another one. You can see that we a little bit overshot, but we didn't close below it, and we overshot it because we mitigated this small zone. Here is another one. Also, it had a low inside it, and as you can see, it worked the same as it works with the zones. Here is another one. So as you can see, there are many of them, but if you're struggling to spot them, you can just type in indicators, just FVG, and just to try to use the indicator to understand how imbalances or fair value gaps look like. But I don't recommend you to use them too much, because they are not always accurate. Here is another one. As you can see, they do not expire after they're getting used. They only expire after they deliver their function. Okay, so now we will talk about order blocks. They're simply down close candles before the up move. I know ICT does not explain it that way, but on this channel we are learning how to get profitable and not how to become PhD master or super pro in price action. So I think this simple explanation will actually help and benefit you. So how to spot high probability order blocks. High probability order block has to have a sweep, then displacement with a fair value gap, and after we create an imbalance, when we retrace and tap the body of the order block, in this case it's closing price or opening price of down close candle, so this is our order block, we reject and go higher. I will show examples later, but also if it doesn't have any imbalances, it's lower probable, it's still an order block. So now we will get a little bit into another scenario. ICT teaches that order blocks are sequence of down close candles, and that's very obvious because the sequence of down close candles, for example, of 3 candles on 1 minute chart is just one 3-minute down close candle. Simple as that. So this entire thing is an order block. So buying inside it is correct, and it will, if you have good narrative, will help you to win a trade on your demo account. So it's kind of hard to explain with the drawings how order blocks look like. So we will get very fast to live examples and see how they work. So this is our first example of high probability order block. As you can see, we have a sweep here, then displacement up, and once we tapped a wick of that down close candle, we rejected and moved higher. This is also QS, but with order blocks I'm not really looking for it to get closed above in single one candle, but that's very good indication. So we have a sweep, imbalance inside, and when we have fair value gaps aligned with order blocks, we use wicks. When we don't have a gap here, we use body of a candle. How to use order blocks to identify order flow? You wanna see down close candles get broken and then used as a support when we are in a bullish order flow, and when you wanna see bearish order flow, you look for up close candles to get broken and then used as resistance later, as you can see here. As you can see, this is another example. We swept a high here. We don't need particularly fail to close, even though, as in previous lesson I explained, that I don't count it as a closure unless we close above this high. So now I usually select a candle that actually swept a high, but I always select only a beefy candle, so candles that have like bigger body. So if this candle looks more like a doji candle, a hammer, I don't like that, I don't use that. This candle is much more prominent, so we will select this one as an order block. This is our bearish order block, and as you can see, price used it to move lower. So after we went through these examples, there are also a couple parts about order blocks. Midpoint of an order block is sensitive for point in price and called mean threshold. You don't really want to see price when trading order blocks to reach it, but if it reached, you want to see immediate willingness in price to go away from it. If it doesn't and stays too long around mean threshold of an order block, your bullish idea in this example will likely fail. So as you can see in this example, we have high probability order block here, and also we have internal sweep, but it tapped 50%, so mean threshold of an order block, and we don't want to see willingness in price to stay for a very long time around it. So if you would have been in a trade from here, because it's the first time I tapped an order block, Once it reach here, you would wanna see if it has any willingness to move away fast from it, and as you can see, it moved away from here quite rapidly. So, hidden SAD is a midpoint of a week, and on a lower time frame, there is always a gap at the midpoint of a week, almost every single time. There is not really much to explain about it, you just treat it as a level of support or resistance. Also, it can be inversed. So use like if it would have broke down here, it would be just support broken turns resistance logic, and it would go lower. Now let's see real examples. To use hidden SND, you wanna always look for a large wicks, like wicks that are really obvious, as this one. You can use them to take one-to-one trade off of them on your demo account, but sometimes you will miss a trade because price won't simply reach them. As you can see, we tapped the midpoint, then moved lower away from it. The same thing here, but we don't have a sell side sweep, so I don't really like it. But we also tapped and delivered one-to-one. Here we tapped an order block. These two up close candles form one single order block, and this wick is, I mean, it's really obvious that it's big. Also, it closed below the low of this candle, so you could trade one-to-one from here and even reach for this low because it has a closure here and didn't close above this candle. Here is another example, very obvious prominent wick, and we tapped it, delivered one-to-one, then created a sweep and moved much lower. You can see if you would try to use hidden SND here, it was just a projection block, basically just body of this candle, and then go away. Here not really a prominent wick, but still would pan out. Here we can see quite obvious wick, but it's counter trend, so I wouldn't take it. Showing and explaining, this example is great. We tapped, moved away, then tapped this order block and dropped lower. Also, that's why you need to have a narrative, because this wick is just a smaller version of this one, but here we tapped min threshold and price also formed a big gap, overlapping another gaps, so it showed willingness to move lower. So if you would have your limit here, I would recommend it for you to take it off because you don't want to catch a falling knife. So you can see a willingness and indication in price that bullish idea is wrong, so that's why it didn't work. And here too, even though it has a flip and an imbalance, this imbalance got overlapped with this one. Here is the last example of hidden SND. Very prominent and obvious wick. Once we tapped it, we moved away. Now I will show you just one or two examples that wicks are actually gaps just on lower time frame. So here is a wick, hidden SND, delivered one-to-one here, very quick. And here delivered one-to-one too. Now let's drop down the 5-minute chart. This was 1 hour, and as you can see, this 1 hour wick actually has a gap exactly at the midpoint, also with an order block. Here we have to drop down even lower. Here you can see we have a gap, but it immediately got close to this up close candle. But the function remains the same. That's it for this lesson. In the next lesson we will go over premium discount, power of 3. And that's basically it for today. See you in the next lesson.